Ever pondered the intricacies of the financial world? The myriad of financial instruments and their respective roles? Well, today we delve into the fascinating realm of finance, breaking down these complex terms into bite-sized, digestible information. Imagine, if you will, a universe of stocks, bonds, mutual funds, and more. Each of these entities represents a unique financial instrument, a tool used by investors and traders to navigate the stormy seas of finance. Let's start with stocks. Stocks represent a fraction of a company. They are traded in the stock market and reflect the company's public ownership. Buying a stock is akin to buying a slice of a company pie, granting you a claim on part of the company's assets and earnings. Moving on to bonds. Bonds are financial securities issued by governments, municipalities, or companies. When you purchase a bond, you're essentially lending your money to the issuer in exchange for periodic interest payments. Think of it as an IOU, where the issuer promises to pay you back with interest. Next up, mutual funds. These are professional financial services where pooled funds from multiple investors are invested across a variety of financial securities. It's like a potluck where everyone brings something to the table, and the resulting feast is a diversified portfolio. Then we have derivatives. These are financial instruments whose value is influenced by an underlying asset, index, or rate. Examples include futures contracts, options, swaps, and forwards. Think of them as bets on the future value or performance of an underlying asset. Commodities are another type of financial instrument that represents tangible goods or agricultural products that are traded in the market, such as gold, silver, wheat, oil, and rice. Foreign exchange, on the other hand, represents the fluctuating values of different countries' currencies. Examples include the dollar, euro, pound, yen, and yuan. Treasury bills are short-term debt securities issued by the government. Investors can purchase them for a fixed period, during which they earn a government-guaranteed interest. Options are a type of derivative where the investor has the right to buy or sell an asset within a specified time frame, but the execution of that right isn't mandatory. Futures are also a type of derivative where the investor agrees to buy or sell an asset at a set price at a future date. These financial instruments help investors achieve financial stability and growth. However, it's always prudent to seek professional advice before utilizing them. In the financial market, various participants play a part. Investors who invest in financial instruments for capital growth and financial security, traders who engage in the short-term buying and selling of financial instruments, banks that provide capital resources, offer financial administration services, and aid in currency exchange. Financial institutions, such as commercial banks, insurance companies, and pension funds, play a significant role in organizing capital and providing financial services. The government, which issues securities like treasury bills and acts as a regulator in the currency cycle. Speculators who make educated guesses on the price of financial instruments and trade them, often with the aim of making a profit. Brokers who act as intermediaries for traders and investors to buy and sell instruments, provide professional advice and regulate transactions. Regulatory bodies like the Securities and Exchange Board of India work to ensure fairness and safety in the market. And international institutions, like the International Monetary Fund and the World Trade Organization, aid in international financial reform and justice. So the next time you come across these financial terms, you'll have a better understanding of what they mean and the role they play in the vast financial universe.